When gold and silver begin to move together, the mistake most people make is looking for a headline explanation, a tweet, a speech, a political comment that can be debated away. But metals don't trade narratives, they trade credibility. Gold and silver are not emotional instruments. They don't respond to outrage, personality, or partisan theater. They respond to something far more fundamental: the structural health of the monetary system. And right now, that structure is under visible strain. Markets love stories because stories are comfortable. They give the illusion that every price movement has a clean, human cause. But precious metals operate outside that framework. They are not pricing what happened today. They are pricing what cannot be said publicly. They are pricing stress in the plumbing. When sovereign debt expands faster than productive capacity, gold notices. When currencies are supported by confidence instead of restraint, silver notices. When geopolitical risk shifts from theoretical to actionable, metals notice. This is why gold often begins moving before consensus understands why. It reacts to pressure building in places that don't show up on television screens, bond auctions that quietly weaken, currency swaps that grow larger and more frequent, central bank balance sheets that never quite normalize. Headlines are lagging indicators. Gold is not. The current surge in gold and silver is not about one political event, one leader, or one geographic flashpoint. Those are surface ripples. What metals are responding to is accumulated stress, pressure that has been building for years and is now finding release. Consider the environment we're in. Debt levels are no longer cyclical. They are permanent. Deficits are no longer debated. They are assumed. Monetary intervention is no longer emergency policy. It is baseline operating procedure. That is not a healthy system. That is a managed decline. And markets know the difference. Gold thrives not during chaos, but during realization. The moment participants quietly accept that normalization is not coming. Silver follows when liquidity seeks not just protection, but optionality. This is not panic buying. This is positioning. When confidence is strong, money chases yield. When confidence weakens, money chases history. Gold and silver are history. They are the memory of what money looked like before promises replaced restraint. The key insight here is this: metals are not reacting to news events. They are reacting to the inability of the system to absorb another shock without dilution. Every geopolitical tremor now requires monetary accommodation. Every fiscal excess requires central bank absorption. Every crisis demands more balance sheet expansion. That loop is visible to anyone who knows where to look, and gold knows exactly where to look. This is why dismissing metal rallies as headline-driven misses the point entirely. The headlines don't cause the move. They reveal the underlying fragility that was already there. They are catalysts, not causes. Gold and silver are not forecasting collapse. They are measuring trust decay. They are not screaming. They are whispering, calmly, consistently, that the margin for error is gone. So when you see metals move in unison, understand what's really happening. The system is speaking through its oldest instruments, and they are telling you something simple, uncomfortable, and historically consistent. This move isn't about today. It's about everything that's been postponed. History leaves fingerprints. Empires don't collapse in a single dramatic moment. They fracture slowly, then reach outward as control at home becomes harder to maintain. Expansion is not always a sign of strength. More often, it is a signal that leverage is slipping. And that is exactly why the Greenland situation matters. Not because of the island itself, but because of what the conversation reveals. When a superpower begins publicly revisiting territorial ambition, even rhetorically, it tells you something critical has shifted beneath the surface. Strong empires don't need to remind the world of their reach. They don't test borders. They don't float acquisitions. They already command trust. Weakening empires do the opposite. They seek assets, not alliances. They reach for land, resources, and strategic positions because influence alone no longer feels sufficient. This is not a new pattern. It's ancient. Rome expanded relentlessly, just as its internal cohesion was decaying. Spain reached across oceans while its treasury hollowed out. Britain extended its empire even as debt and overextension quietly undermined it. Territorial ambition always peaks late in the cycle. And markets remember this, even when politicians don't. Greenland is not just ice and geography. It is leverage, strategic minerals, Arctic positioning, military advantage, resource optionality in a warming world. When control of real assets becomes more important than trust-based systems, it signals that the abstract power of currency, diplomacy, and soft influence is no longer enough. Hard assets re-enter the equation when confidence fades. This is where metals intersect with geopolitics. Gold and silver don't respond to speeches, they respond to behavioral shifts. And territorial posturing is one of the clearest tells that the global order is becoming more transactional, more zero-sum, more brittle. In those environments, paper claims lose priority. Physical reality regains value. Imperial overreach is not reckless by accident, it is forced by necessity. When domestic consensus fractures, when debt constrains options, when credibility wanes, leadership seeks external focus. External ambition distracts from internal fragility. But markets see through it, they always have. This is why gold rises during moments of geopolitical assertion, not retreat. Assertion requires funding. Funding requires borrowing. Borrowing requires confidence. And when confidence is stretched, dilution follows. Territory costs money. Power, projection costs money. Maintenance of dominance costs money. And money in late-stage systems is created, not earned. Silver's role here is equally telling. Silver reacts not just to fear, but to industrial reality. As competition over resources intensifies, silver's dual role as money and material becomes impossible to ignore. Strategic rivalry increases demand for real inputs, not just financial abstractions. This is not speculation. It's repricing. The Greenland discussion isn't a policy plan. It's a stress indicator. It reveals that the world is drifting away from post-Cold War assumptions of stability and into a more fragmented, resource-focused era. An era where balance sheets matter more than promises, where supply chains matter more than speeches, where gold and silver matter more than yield curves. So when you hear laughter, dismissal, or shock at territorial ambition, remember this. Markets don't laugh. Metals don't mock. They adjust. They recognize the phase shift. Imperial overreach doesn't announce decline. It confirms it. Not collapse, but transition. From trust-based dominance to asset-based power. From abstraction to substance. And in that transition, gold and silver don't lead the story. They quietly record it. This isn't about Greenland. It's about what happens when the world's monetary and geopolitical systems begin speaking the same uncomfortable language again. The language of history. One of the most dangerous misconceptions in financial markets is the idea that major moves begin with excitement. They don't. They begin with silence. By the time retail notices gold and silver moving, the decision has already been made elsewhere. In places that don't tweet, don't speculate, and don't explain themselves. This is not a Reddit trade. This is not momentum chasing. This is not emotional positioning. This is institutional behavior. Large players don't chase headlines. They manage risk. And risk today does not come from volatility. It comes from structural erosion. Pension funds, sovereign entities, central banks, and balance sheet managers are not trying to beat the market this quarter. They are trying to survive the next decade without being diluted into irrelevance. That changes everything. The debasement trade is not about betting on inflation tomorrow. It is about acknowledging that the monetary system no longer has a politically acceptable exit from debt expansion. There is no austerity path. There is no normalization path. There is only continuation. And continuation means dilution. Institutions understand something retail is never told. When debt reaches a certain scale, it stops being repaid and starts being managed. Managed through maturity extension. Managed through yield suppression, managed through currency debasement. Gold and silver sit outside that management framework. They cannot be rolled. They cannot be restructured. They cannot be printed. That alone makes them dangerous to the system and indispensable to those protecting against it. Watch what institutions do, not what they say. Central banks don't announce loss of confidence. They accumulate quietly. Sovereign funds don't tweet fear. They rebalance exposure. Commercial banks don't advertise concern. They adjust collateral preferences. These are slow, deliberate moves, but when they converge, price responds. That's what you're seeing now. Retail investors often ask, why didn't anyone warn us? They were warned, just not with words. They were warned through settlement data, through delivery requests, through shrinking liquidity in physical markets, through widening spreads between paper claims and tangible supply. That's institutional behavior leaking into price. The debasement trade doesn't require belief in catastrophe. It requires recognition of constraints. Constraints on political will, constraints on fiscal discipline, constraints on monetary credibility. Institutions don't fear collapse. They fear gradual confiscation through dilution. Gold protects against that. Silver hedges the tail. This is why institutional buying is often invisible until it isn't. It doesn't spike sentiment, it drains availability, it tightens markets, it turns small shocks into large moves. By the time headlines catch up, positioning is already complete. And here's the critical insight. Institutions are not buying metals because they expect chaos tomorrow. They are buying because they cannot model a future where real yields stay positive without intervention. And intervention always has a cost. That cost is paid in currency. The debasement trade is not a bet. It is a defensive allocation. It's the admission that the system's promises require perpetual expansion to remain credible, and that perpetual expansion eventually collides with reality. Gold and silver are where that collision is absorbed. So if you're waiting for retail enthusiasm to validate this move, you've already missed the point. Retail follows volatility. Institutions front-run decay. And right now, the quiet money is speaking very clearly, not with panic, not with drama, but with accumulation. This is not a frenzy. It's a migration. And once migrations reach the surface, they don't reverse quietly. One of the most persistent illusions in modern finance is the idea that gold goes up. It doesn't. Gold doesn't rise the way equities rise. It doesn't compound. It doesn't innovate. It doesn't grow earnings. Gold simply measures. And what it is measuring right now is the slow erosion of currency value. When people say gold is rallying, what they're really saying is that money is being diluted. Gold is not creating wealth. It is revealing loss. Loss that is otherwise hidden by nominal numbers, asset inflation, and carefully managed statistics. Fiat currency is designed to lose value gradually. That is not a conspiracy. It is a policy choice. Moderate inflation is considered necessary to grease the gears of debt-based systems. But when debt reaches a scale where it cannot be serviced without constant expansion, dilution stops being a feature and becomes the engine. And engines run hot. Gold reacts not to inflation headlines, but to credibility gaps. The gap between what currencies promise and what they can realistically deliver without intervention. When that gap widens, gold responds. Not violently, not emotionally, but consistently. This is why gold often performs best during periods when official inflation appears contained. The real issue is not prices. It's purchasing power over time. Gold doesn't care whether inflation prints at 2% or 6%. It cares whether the currency is being asked to do something impossible. Preserve value while absorbing infinite liabilities. That equation never balances. Central banks understand this better than anyone, which is why, quietly, persistently, they continue to hold gold. Not because they expect to return to a gold standard, but because gold is the only asset that does not represent someone else's promise. No counterparty, no yield, no liability. Just final settlement. When currencies weaken, policymakers rarely admit it directly. Instead, they redefine success. Rising asset prices are framed as prosperity. Debt expansion is framed as stimulus. Currency dilution is framed as growth. Gold cuts through that language. It shows you what the currency is worth when words are stripped away. Look at gold not in isolation, but against purchasing power, against housing, against energy, against food. Over long arcs, gold doesn't outperform. It keeps up. That's the point. Gold is not an investment. It's a control sample against monetary drift. And that's why gold becomes uncomfortable during late cycle phases. It exposes what policymakers would prefer remain abstract. It reveals that stability has been borrowed from the future. Every bailout, every emergency facility, every temporary measure that never ends, all of it accumulates, and gold tallies the bill. This is also why gold is dismissed during booms and rediscovered during stress. When confidence is high, people want return. When confidence fades, they want truth. Gold tells the truth. So when you see gold moving higher across currencies, not just dollars, understand what that means. This is not a US problem. It's a global one. All fiat systems share the same constraint. Political incentives favor expansion over restraint. Gold exposes that universally. Gold is not screaming collapse. It's calmly stating that value is being diluted faster than narratives can contain. And that statement becomes louder when debt grows faster than trust. Gold isn't bullish. It's honest. And right now, honesty is in short supply. Silver is never first, and that's why it's dangerous. Gold moves when confidence cracks. Silver moves when confidence breaks. It lags not because it's weaker, but because it straddles two worlds the system would rather keep separate: money and industry. And when those worlds collide, silver doesn't drift. It snaps. Silver is monetary memory with an industrial heartbeat. For thousands of years, silver wasn't a trade. It was currency. Wages were paid in it. Empires accounted in it. Debasement was measured through it. Long before charts and CPI prints, silver told populations whether their rulers were cheating. That memory never disappeared. It just went dormant. Modern finance tried to reduce silver to a commodity, something consumed, modeled, hedged, and forgotten. But history doesn't erase that easily. Silver remembers its role, and when monetary stress rises, it reasserts itself violently. That's what awakening looks like. Unlike gold, silver is small, thin, under-owned, and structurally mispriced relative to its historical role. That makes it volatile, but volatility is not randomness. It's compressed truth. Silver doesn't whisper, it moves in bursts. When gold begins signaling dilution, institutions position quietly. But when silver starts to move, it's because the market is realizing that monetary stress is bleeding into the real economy. Into supply chains, into energy systems, into strategic materials. Silver sits at the center of that convergence. This is where silver becomes dangerous to paper markets. Silver inventories are finite. Production is inelastic. Above-ground supply is thinner than most models assume. And unlike gold, silver is consumed, lost, used up, not easily recycled at scale. That makes paper claims fragile, and fragility is exposed during stress. Silver doesn't require panic to move. It requires realization. The realization that monetary dilution doesn't stay abstract. It eventually collides with physical demand. Solar, electronics, defense, energy transition, all demand silver. None can print it. This is why silver moves later, but faster. Once confidence in paper pricing weakens, leverage unwinds brutally. Paper markets depend on faith that claims can be settled. Physical markets care only about delivery. When that gap widens, silver reprices, not smoothly, violently. Historically, silver outperforms gold in late cycle phases, not because it's safer, but because it's more honest. It exposes leverage, tightness, and misallocation all at once. Silver doesn't tolerate excess, it punishes it. This is why silver rallies feel chaotic. They aren't driven by optimism, they're driven by structural correction. The market is forced to reconcile decades of suppression, mispricing, and neglect in a very short window. That's not speculation, that's reckoning. Silver's awakening is not about price targets or ratios, it's about role recognition. The return of silver as a monetary signal in a world that thought it had outgrown such things. But systems don't outgrow physics, and silver is physical. When silver starts moving alongside gold, it's not confirmation. It's escalation. It means monetary stress is no longer confined to balance sheets. It's bleeding into production, energy, and real-world constraints. That's when the system loses flexibility. Silver is not leading the story, it's revealing the consequences. And once silver wakes up, history suggests one thing very clearly. The adjustment phase has already begun. The most comforting lie markets tell themselves is that everything is temporary, that every surge can be faded, every crisis can be managed, every distortion can be normalized away. But history is brutally consistent on one point. Structural shifts do not announce themselves as revolutions. They masquerade as noise. What we are witnessing in gold and silver is not a spike driven by fear, speculation, or momentary panic. It is a repricing of assumptions that have governed the global system for decades. Assumptions about debt, assumptions about growth, assumptions about trust. Those assumptions are breaking down. Short-term moves are violent and emotional. Structural shifts are slow, methodical, and relentless. They don't reverse on good news because they aren't caused by bad news. They are caused by constraints. And constraints do not negotiate. The constraint today is simple. The global system is saturated with debt, and the only politically viable solution is more currency creation. That is not ideology. It is arithmetic. No government can meaningfully reduce deficits without social instability. No central bank can allow real yields to remain restrictive without triggering systemic stress. No reserve currency issuer can tighten indefinitely without fracturing the global order it underwrites. So the system chooses dilution. Every time. That choice doesn't collapse markets overnight. It reshapes them. It changes what capital prioritizes. It changes what risk means. It changes what safety looks like. Gold and silver sit at the center of that redefinition. This is why calling the current move a rally misses the point. Rallies end. They exhaust buyers. They revert to the mean. Structural shifts don't exhaust. They normalize at higher levels. They reset baselines. We are not returning to a world of disciplined balance sheets, restrained monetary policy, and trust-based globalization. That era depended on demographics, growth, and political cohesion that no longer exist. What replaces it is messier. Fragmentation instead of harmony. Assets instead of promises, resilience instead of efficiency. And money behaves differently in that world. In structurally shifting environments, capital stops chasing maximum return and starts prioritizing minimum regret. Investors don't ask, what can I make? They ask, what can I not afford to lose? Gold answers that question cleanly. Silver answers it violently. This is why every attempt to suppress or dismiss metals ultimately fails. You can cap price temporarily. You can distort futures markets. You can change narratives. You cannot erase physics. You cannot print trust. The most dangerous part of structural shifts is that they feel boring while they're happening. No single moment feels decisive. No single chart looks catastrophic. Until suddenly, the old playbook stops working. Stocks stop hedging risk. Bonds stop providing safety. Currencies stop preserving purchasing power. That's when people realize the shift happened years earlier. Gold and silver are early in that realization curve. Not early historically, but early psychologically. The system is still pretending this is cyclical, reversible, manageable. But metals are already pricing the end of that illusion. This isn't about collapse, it's about reordering. A slow migration from financial abstraction back toward tangible anchors. From trust in policy to trust in substance. From narratives to reality, short-term spikes burn out. Structural shifts change behavior. And behavior, once changed, does not quietly revert. So if you're waiting for this move to cool off, ask yourself what would have to reverse for that to happen. Debt discipline, political restraint, monetary normalization without crisis? Those conditions no longer exist. This is not a trade. It's a transition. And transitions don't ring bells. They just keep going until everyone realizes they're already on the other side.